Making some faces over there. You want to introduce ourselves?
It sounds like you're doing the introduction. Oh, are you ready for me too?
Yes, I'm ready.
Okay, great. Well, welcome to our webinar today, where we're going to be talking about protecting and growing your retirement account, even in this crazy market. What you can do, what your options are, so that you can get out of fear and uncertainty. And we want to help create more certainty and confidence when it comes to your retirement account. Okay, so we're going to be talking about that today. It's going to be a brief webinar. You're going to love it. You're going to learn something new, and then we're going to show you how we can help you. So as you're coming in, please, as you're coming in, let us know where you're tuning in from. Please share this out if you know anyone that may be able to benefit from this. And put your comments. If you have any questions in there, go ahead and put them in there. We'll do our best to answer them live. If we don't get to them live, we definitely will follow up with you and answer your questions. Okay, so grab a pen, grab a paper, like, comment, and share, and we are going to get started.
Awesome. So let me put this up here. All right.
What up, Brandon? Hey, Roberta.
Hey, Roberta.
And some people say Facebook user. I don't remember if that's an easy fix.
Somebody said, "Oh yeah." So awesome. If you guys are watching in our Facebook group, just click allow StreamYard, and it will allow you to display who you are, so we can show you, so we can see your beautiful faces. Okay, so let's get rolling here. All right.
And hey, Rain, someone's saying the links don't work. If you could,
I think they're back.
They got in. Okay, good. Okay. All right. So welcome to how to protect and grow your retirement, even in this crazy market with uncertainty and fear. How do you create more certainty and get rid of the fear, right? So you can be confident that you have a strong, successful retirement. So if you don't already know who we are, we're Martin and Chelsea Matthews. We are founders of M Wealth Group. We have clients in 48 states, and we have a combined 21 years experience, if you could believe that. So we lead an agency of associate advisors. We've held multiple licenses in the field of investment advisory, securities, and insurance. And we're also co-authors of this book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house. We help individuals and businesses to properly use cash flow and to create personal wealth. And our mission is to deliver measurable results to help our clients build an unbreakable financial house and business so they can be free to live life by their design. Okay, so when we say unbreakable financial house, what that means is that you can create the life that you want. You can handle anything that comes your way financially, and you can make the impact that you really want in your life, your community, and beyond. It's not just about paying bills. It really is about creating the life you truly want to live.
So that's some of the members of our team here in the office.
Yes, this is some of our amazing team members. And we believe that the lack of education is one of the greatest economic crises of our time. And I'm going to tell you how we are doing our part to help solve this crisis. And this is what we're going to do today. This is how we're going to deliver the information to you. This is how we deliver the information to our clients as well. Is one, because we want to empower you to make the decisions yourself. We're not just telling you, hey, we're genius gurus, we have so much experience, just do what we say. No, we want to help increase your knowledge so you could take more responsibility for your actions, and you can have more control over your results in your life, in your business. All right. So one of those things, the first thing to increasing your knowledge when it comes to your finances is understanding what makes up your financial house. We're all building a financial house, whether you realize it or not. You may have a financial shack, you may have a financial mansion, or you may be somewhere in between. So by understanding what makes up your financial house and how to strengthen it is really the first step. So this is just a quick snapshot of the 6 building blocks that make up your financial house. We're not going to cover them all today. We have resources for every single one. And if you want help in any of the other areas, feel free to reach out to us. But today we're going to focus on building block number 5.
You can screen capture this, by the way, so if you're not watching your phone, you can screen
I don't know
capture.
if they can see this here, but building block number 5 is build wealth. And that's the one that we're going to cover today. Okay. And Martin's going to show you how you can understand what options you have when it comes to your retirement to strengthen that wealth, grow it, and make sure it's there when you need it.
Yeah. Awesome. So, and if you're watching on Instagram, send me a DM and we'll get you the recording of this so that you can actually see some of the screens. So right now you guys are just kind of listening to it, but send us a DM and we'll get you recording of it.
On my Instagram too, if you send a DM, we'll send you the recording and you get all the screenshots and everything, or slides.
So the whole concept of this is how to protect and grow your retirement during a down market. So from the beginning of this year, the market's down. Market, and when we're talking about the market, we're generally referring to the stock market. And so the S&P 500, which is the largest 500 publicly traded companies in America, which is a benchmark how the American economy is doing, how those companies are performing based on their stock price, that's down. Now, whenever a market is down from its high, it's down 20%, it's considered what's called a bear market, which means people are thinking this market is trending downwards. And so when that happens, the vast majority of people who have traditional retirement accounts, your 401ks, IRAs, things like that, that sees an impact, a negative impact. So we get a lot of questions about these, and we thought we would do a webinar and then share with you what are some of the things you can do to handle that. And then Rain, would you mind sending a text out as a reminder, just in case if people didn't know we're going live right this second, that so they're aware that we're live. So okay, now handling your current 401k. So this before I get into that, let me preface this by saying this is for educational purposes. Our goal, like Chelsea mentioned, is to help educate people so that they can make better decisions. Now, we're not, anything we go over or talk about is not specific investment advice because we don't know your particular financial position. So we're going to show you some different things and things to think about. And at the end of it, we'll show you how to get more specifically from us. That way you can see your exact financial position, what some of the things you can do specifically as it applies to your particular position that you're in. So that's one aspect of it. The other thing is just pay attention to some of the different things we'll talk about. It's going to be a lot of noise all around social media and all in the media. Look to do what is best for you in your situation. All right. So first thing, when it comes to handling your, and also so you may or may not have a retirement account already. Maybe you're thinking about setting up a retirement account. This webinar is more for people who already have a retirement account and they're concerned about what happens to it, how to handle it if the market goes down, as it's been doing. So market's been down about 20% since the beginning of this year. How do you handle your current 401k? Meaning you're working somewhere and you're contributing to the 401k that you have now. And maybe you've seen it go down, or maybe you've been looking and wondering, hey, what's happening? What should I do? So the first thing you need to do is you need to log into your account and review your statement. So either you're going to get a statement, sometimes you get a quarterly statement or an annual statement in the mail, but you should also have online access to your 401k. So make sure to be able to log, if you've never logged into or haven't logged into it for a while, confront that. First thing you got to do to handle anything, you got to confront it. So first, you got to look at it, right? So when it comes to your retirement, you need to know where it's at. So log into your account and review your statements. So that's the first thing you do. The next thing you do after you log into your account and look at your statements is to look at how are you allocated. Allocated means inside of your 401k, you have different investment choices. So generally speaking, you have something called mutual funds inside of your 401k. There's growth mutual funds, balanced mutual funds, aggressive mutual fund, all of that, right? You have these different basket of funds that you have your money inside of your 401k. So look at what funds you're invested in, and you can look at how have those funds performed. An easy way to look at that, just say, okay, so how am I doing is what you really want to look at overall. And then over the years, the market have been going up. So you may have been doing well in some of those funds. But it may be no longer your risk tolerance. Like more of your money might be in a more aggressive position than you may have wanted to, just because those perform better when the market was going up. So how are you allocated? Meaning, how is your money inside of your 401k? How is it currently invested? What are you in? Look at that. And if you don't understand that or know how to look at it, stay tuned to the end. We'll show you how we can help you with that. How we can help you get access to learning those things. Review how you can get a review from us on those kinds of things. If you have no idea how your 401k is allocated, maybe you signed up for your 401k years ago and you've never changed anything. That happened to me when I first came to America. I got a 401k. I never looked at it. I checked some boxes. I didn't look at it for years. I had no idea what was happening. So I had no idea how I was allocated. So that's one of the things you can do. We can help you understand how you're allocated to see if that fits your risk profile. So that's the second thing you do. Check your account, number one. Number two, look at how you allocate it based on the funds you have in there. The third thing you can do after that, once you know that, is you can decide if it's the right amount of risk for you. Now, we have a questionnaire, a little quiz you can take to find out what your risk tolerance really is. So some people will say whenever markets are doing well, a lot of people think they're aggressive because they want to make more. They want all those upside. When market goes down, they're not as aggressive anymore. Well, that person really wasn't aggressive to begin with. They were probably a moderate or a conservative investor. They just wanted to see their account keep rising. So to handle that, you have to understand what is your risk profile and what's your risk tolerance. What's your appetite for risk, so that the way you're invested in your 401k matches your risk tolerance. Like me, when I first came to America, I got a 401k. I didn't know anything about it. This was 20 something years ago. I didn't know anything about it. I didn't know how it worked, anything like that, way before I got into this industry. And then I checked the box that said growth, because it said growth mutual fund. And so I was like, okay, I wanted to grow, so I checked growth. Well, that was one of the most aggressive portfolios I could be in, but I didn't know that. And so I didn't understand how to adjust or how to change it or what to do about it. So that was one of the key things, was understanding how you allocate it, and then looking at how those funds are invested to see if that still matches your risk tolerance and if you need to change anything. Now, if you find that you're way more aggressive than it needs to be, like you're shocked, you're like, oh my God, I can't believe I lost this much since the beginning of this year. Then what you can do is what I call de-risk. You can look at rebalancing your portfolio inside your current 401k. Most of your 401k plans can allow you to change your investment allocation online. You can go in there and you're like, okay, I'm in these funds. This seems to be more aggressive than I want to be. I've made some gains, but maybe I want to protect those gains I've made, and I want to reallocate within my plan. You don't have to move any money out of your plan. There's generally no cost for this. There's generally no tax implication as long as the money stays within your 401k plan. Right now, we're talking about your current 401k, meaning you are contributing currently to a 401k at your current job. Now, or business, you can have a solo 401k. So you may want to de-risk. Now, a few years ago, we did something like this for my mom. And so she was getting ready to retire. My mom is retired now. But she was getting ready to retire. She had made some gains in her 401k. But she was, as the market went down, started to go down, then we're like, okay, maybe we need to de-risk a little bit. So the money that was in there, we readjusted our portfolio to where it matched her risk tolerance. The new money she was adding every month, because if you're contributing to your 401k, you're adding new money every month. That money still went into her previously aggressive allocation, but the gains that she had made, she repositioned that. So you can do that within your plans if that works for what you're looking to do. If you're thinking you're taking on too much risk, rebalance your risk, rebalance your portfolio to match your risk tolerance. If you don't really know what your risk tolerance is, reach out to us. We will help you to understand it so that you're allocated properly inside of your 401k. It's something that you can do on your own with your 401k. You go in there, you can make some changes and different things like that. That would generally allow you to make a couple of changes throughout the year in your existing 401k. So there's that. When you're adding new money into an account, you benefit from buying shares or buying parts, adding more to that mutual fund when it's down, because you're actually able to buy it at a lower cost. However, if you've accumulated a sizable position over the last few years, you want to protect what you've accumulated. So you may want to de-risk that while you continue to add more money in there. So that would be a way that you can handle your 401k, and make sure you're protecting yourself so that the gains you made are protected while you're still adding more to it. All right. And if there's any questions, guys, drop them in the comments. Let us know. Hey, can you explain that? Or what does that mean? Anything like that. We're happy to answer those questions for you. If you like our content, share, invite other people to it so that they can understand. Because this is the number one question we're getting right now. What do I do with my retirement account? Because the market's been down. That's something people are very concerned about. Okay. So next, we'll go through how do you handle your old 401k? So an old 401k is a 401k from a job you're no longer working at. So you used to work there, you had a 401k there, you left, and your 401k still left there. What do you do? How do you handle it? So you start by doing the same process. First, you got to log into your account. You got to review your statements that you received and see where you're at. Old 401ks often get neglected. They get forgotten about because you left that job. You're now at a new job. Maybe you're doing something different. You may have forgotten about that 401k. And you need to know what's there, how much it's there, what's it doing, those kinds of different things. Now, once you log in and see what it is, you have a few options. Number one, you can just keep it there. If you like how it's done, you can leave it there. That's an option. It's not something we often recommend because when a 401k is with a previous employer, you're no longer working there anymore. So, you may want to take more control of that 401k, and you can actually roll it over. You can move it out from a 401k and you can roll it over into an IRA, which is called an individual retirement account. That way you have more options beyond just what's in the 401k. You can place with many different companies. And I think you have more attention on it than if it's left back there in the old 401k. So that's something to keep in mind. That's another way to handle it. I'm going to show you guys an example of how some of our clients who have rolled over 401ks, what they have done. Now, granted, there's different vehicles and different ways we help our clients and different things we help our clients to do. If you have an old 401k, this could be something you consider doing, or even if you have an existing IRA and you look at it and you want protection, you want to be able to protect and grow even in a down market. I'll show you an example of one of our clients who did this and what the results have been. It's not something you absolutely have to do. You can just simply leave your 401k there if you want. I probably wouldn't do that for me, but you have the option to do that. It's not something you have to roll it out. Sometimes if you have not worked there for a long period of time, or your balance is below a certain amount, sometimes the company makes you take it out because they're paying a servicing fee for keeping those accounts there. So a lot of times they will tell their former employees to roll their money out. So in this next slide I'm going to walk you through an example of one of our clients who rolled over assets into a plan, that one of the plans and strategies that we use, and how it's been doing just even in the last month. So on the top here, you'll see the date. It says 5/4/2022. So literally over a month ago, the client moved $400,000. Now, again, this is just for example purposes. This is an actual real client, but your situation may be different. So the client placed $400,000 with us into one of the strategies we talked to them about that was appropriate for them. This is a client who is concerned about making sure they don't lose money. That was one of the biggest concerns. They're like, this is the money I need. I need to take some cash flow from this money in the future. I want to make sure I don't lose money. This is not meant to be a very volatile asset that they place in their client's other concern was they wanted to make sure their money could last. So when they get to retirement, they want to make sure they get a check every month for the rest of their life. So that was something that was very, very important to them. They didn't want to lose money and they wanted to get a check every month. So pension plans used to do this. Used to work for a company for 30 years. And when you retire, they'll send you a check every month for the rest of your life. That was called a pension. Well, pensions went away. So now you have to use your 401k, your retirement account to create the same outcome for yourself. So this is one of the vehicles that help the client to do that. So this was over a month ago. The client placed 400,000. I remember market's been down. Now, as of this date, so you see 6/16, so a little over a month, based on income, the client's using this for income. So the client, they're going to use this amount, 480,000. So the client put $400,000 in, it's up to $480,000. The client got a bonus, and the client would get 10% credited to their account every year for the first 10 years. And then it's going to go to 5% a year after that. So generally, this type of strategy we use for retirement accounts, where the person isn't planning to touch the money right away, and they're wanting to make sure they don't lose money or go backwards, and they want to make sure they get income for the rest of their life. So it says here, based on single life, because it's based on one person's life. So they'll get a check every month for the rest of their life, no matter how long they live. So we're able to help this client protect the funds that they have and grow it, even though right now the market's down. So again, if you want to know more about this particular strategy, it's not meant to get into the details and all that on this webinar. But if you want to know more about the strategy, at the end, we will show you how you can get a review from us. And then if this is appropriate for you, we'll discuss that and show you some numbers and different things like that for your particular situation. So that's one of the things we help our clients. We help our clients with lots of things, like Chelsea said, help our clients in lots of different areas. But this is one of the things that we do that we're very proud of when it comes to their retirement, is we're able to make sure to help them. So I'm very proud of the fact that I helped my mom with her retirement account. My mom's been retired for, I think, a year or two now. So that was very cool. And we have a lot of clients of ours who are retired, and they generate cash flow from their accounts. And that's what they're using to live on, because we help put some good plans into place for these clients. And a lot of them have been our clients for a long, long time. So next thing is handling your current IRA or Roth IRA. So we talked about 401ks. IRA is a little different. IRA stands for Individual Retirement Account. So when you have a 401k and you leave your job, you can roll that money over into an IRA. It is not a taxable event if it goes from a 401k and it goes directly into an IRA, right? So it's not a taxable event. You don't have to pay any taxes on it. You're basically just changing it from the money's with your employer in your 401k, and your employer sponsored 401k plan. Your company, your employer, is the one who sponsors the plan, who puts the plan there, and then you use the plan. Right. So now when you leave that employer, you can move that money to your own account, which is what's called an individual retirement account. So if you have a current IRA, maybe you rolled over a 401k a while back, something like that, you want to do the same things. Log into your account, check on it to see what it's doing, how it's performing, things like that. Okay. Once you're aware of it, you don't have to stare at it every day. I don't recommend staring at it every day. But just to check in to see, okay, here's where it's at. Here's what it's been doing. Now, is there something else I might need to do with it? So if you would like, you can keep your current IRA where it's at. You can also transfer your IRA to other accounts. So if there's something that if you want more benefits, you want to reduce your market risk, you want to keep growing and expanding your IRA accounts, things like that, or your Roth IRA, you have options that you can reposition assets. Also, like we talked about, you may want to de-risk. You may want to de-risk your portfolio. You may want to buy real estate. You can even use your retirement accounts to buy real estate. There's some steps you have to go through to do that, but that is also a possibility. If the goal of any retirement account, I always teach people this, the goal of any retirement account is cash flow. Retirement accounts, the job of a retirement account is cash flow. All right, so a lot of advisors will tell you, what's your retirement number? And the idea is you want to get to $1 million, or $2 million, or $3 million, whatever the number is. But you're not going to spend $1 million in 1 year. Maybe you might, but the goal is not to spend all your retirement money in 1 year. So what are you going to do with the retirement money? You're going to generate cash flow from the retirement account. That's the idea. It's to produce revenue for you, income to your household when you're no longer working, or you choose to not work, or you choose to do something different. That's the purpose of a retirement account, is to produce cash flow. So the goal of a retirement account is to produce cash flow. You want it to be predictable as possible, so that you can plan better. Because what you don't want to be is 80 years old and you run out of money in retirement, which is the number one financial fear of people over 60, that they're going to run out of money in retirement. They're going to be they're going to be 70 or 80 or 90 and have no more money left. This was the case of my grandmother. My grandmother was in Liberia, West Africa. That's where I was born. And she had no retirement. She had no resources, no money, zero, no income from anywhere. So how is she going to live? Well, she had to depend on us, our grandchildren. My father passed away, so now the responsibility fell to my siblings and I. So we used to send her money every month to take care of her. So that's people who are getting close to retirement, their biggest fear.
So someone asked, what about a 403b?
Same concept with the 403b. Good question. So 403b is generally for people in the education space, like school teachers, university professors, first responders, all people who work in the government, public service, things like that. Same rules as generally same rules as a 401k. If you are over 59 and a half, most 401ks or 403bs can allow you to, your current 401k or current 403b can allow you to roll money out while you're still working there. So you can actually roll it over into your own individual retirement account, even though you're still working there. You may want to do this if it gives you more options. We did a lot of this with people in the military and people who worked at the VA through something called a TSP, called a thrift savings plan. All of these, they work very similarly to your 401k, 403b. When you're 59 and a half, if you work for the government, you can roll your money from the TSP into your own individual retirement account if you want more options, if you want more choices. Maybe you want some guarantees on your assets. Maybe you don't want the bulk of the money that you've built up already exposed to the market. Maybe you want to de-risk and still get gains, so you can do that. So still works for 403bs. You can still use them. Still use this, the concept still the same. You can roll it over, or you can keep it there. But you still want to know where it's at and how it's allocated, so you can know if it's still properly allocated for you.
So if you have one of these types of accounts, a current 401k and you're 59 and a half, or an old 401k from an employer, that you're no longer working at, an IRA, a Roth, and you want some help to review these accounts and knowing what options that you have to be able to protect and grow so that you can rely on those retirement funds when you need them, then we would like to help you to review your account. Now, usually for our clients, we require that they have at least $100,000 in their retirement account to be able to qualify for a review. But we do want to make that available to more people. And so if you have at least $50,000 in your retirement account and you would like a review, the review is free. You can go to 6buildingblocks.com/retirement. It's 6buildingblocks.com/retirement. And we'll be happy to help you to review your account, what options you may have, and any recommendations to help strengthen, protect, and grow your account is what that includes. So we would be happy to help. Please reach out. If you have any questions, you can put them in the comments. You can DM us. And if you guys on Instagram would like to see the slides that we shared, you could DM. If you are interested in a review, then you can DM us also, or you can go to 6buildingblocks.com/retirement.
Yeah. So look, you got to one of the biggest things to understand as an investor is your risk tolerance and how you're invested. Does it make sense for you? What your goals are? A lot of times your goals may change. The things you want to invest in may change. You may have gotten a 401k. Before I got into this industry, the guy I started working with first, my very first mentor, one of the questions he asked me was, he asked me, Martin, have you ever gotten a 401k at your job before? I said, yes. And he said, how do you know the 401k was the best thing for you? And I didn't have an answer for him. I didn't know that it was the best thing for me or not.
That's what they gave me.
Because that's what I was offered. I'm not saying it is or it isn't. I said, how do you know it's the best thing for you? And so you get the options that's available, that's in your plan, and you're limited to those options. So maybe you want different options. Maybe there's different things you want to do. Maybe you have different goals now. So when you start thinking about that, you can do some of those kinds of different things. Now,
I will read this question for you.
Okay.
Is there a time limit when one can transfer their TSP into another retirement vehicle?
No, not necessarily. If you're separated from the military,
And TSP is for people in the military. Their
people in the
retirement
military,
account.
people working generally in the federal government, the military, VA, there's a few others, like some contractors get TSP. So there's not really a time limit. So if you're separated from the, as long as you're separated from the military, if you're under 59 and a half and you're separated from the military, they generally just allow you to roll it over whenever you want. So you go in there. I think a lot of times you got to get like a PIN number to log in to review the accounts. We have a lot of clients in the military. I know my cousin Roberta, she retired from the military. So it's cool. You can reallocate your TSP. They don't have a time limit on when you can do that, generally speaking.
All right. Anything else?
Yeah. So lastly, what I'll end with this is look, if you guys have any questions, message us. You guys can go and sign up for the free retirement review. It's a way we're trying to help people get prepared. My personal opinion is that the Federal Reserve raised interest rates recently. I think they're going to raise the signal that they're going to raise interest rates again. When you see that happening more and more, people get a little bit sour on the market. So as you're exposed to market risk, it could be that you see more of your retirement account gets evaporated in the market, which is why you want to review to make sure you're taking on the kind of risk that's appropriate for you with the assets that you have, especially if over the last few years you've strengthened your position. For retirement accounts, I think the more you can make them predictable, the better, because then you can plan better for your outcome. Now you can do lots of other things. Other things you can do where you can have volatility in other assets, but your retirement is something different. Your retirement is something that you're looking at for a specific period to do a specific job for you.
Money that you have to count on.
Yes, do a specific job for you, and so that's where. So if you guys have any questions, feel free to drop them in the comments, DM us, message us. We're happy to help you. You can go to sixbuildingblocks.com/retirement to request your free retirement review. All right, guys, we will see you next time.
Bye.